So, welcome to today's presentation. My name is Peter Yusuf, Senior Market Analyst at IronFX. We're going to be mixing technicals with fundamentals today, as always. For the technical side, we're going to be using one-day charts. Should we switch, we'll let you know. And if you have any trading instruments you would like to have a look at, just let us know in the chat box. We start with Euro USD. Now, Euro USD dropped yesterday, actually continued its drop since Friday, yet seems to have stabilized during today's Asian and early European session. That happened after hitting the S1 1.1025. Mind you that it's the second time that the level seems to be able to stop any bearish tendencies of the pair in the past week. I would maintain a bias for a sideways motion to prevail, and I'm basing this on two reasons mainly. The first would be that we have, as noted, no lower trows, despite having lower peaks like one peak, lower peak. But on the other hand, the trows are lacking. We have a stabilization of the pair on the 1.1025. On the other hand, I would be also noting the RSI indicator, which remains near the reading of 50, implying rather indecisive market, which could allow the sideways motion of the pair to be maintained. Mind you that the Bollinger Bands are still narrowing, implying low volatility for the pair. Once again, supportive of a possible sideways motion between the 1.1025 and the 1.1120. Now, for bearish outlook, given the intense downward motion of yesterday, I would expect or require actually the pair to breach the S1 1.1025 and start aiming, if not reaching, the 1.0915. On the flip side, for bullish outlook, I would require the pair to reach the R1 1.1120, breach it, and aim, if not reach, and breach the R2 1.12. 1.12, by the way, provided considerable resistance right here. It had stopped the upward momentum of the pair since the 2nd of August. And it's quite valid. On the fundamental level, from the USD side, there's not much. Once again, I'm highlighting the release of the US CPI rates tomorrow. They are for August. And the big question here is, given that we have already the US employment report for the same month, which was released on Friday, showing a slight tightening of the US employment market if compared to July, I think the next big test for the USD is going to be inflation. And at this point, the CPI rates are critical. Should we see the US CPI rates on a headline and a core level actually failing to slow down as the market expects, and the Fed as well, that could force the market to reposition itself and provide, in my opinion, a symmetric support for the US dollar. It would take the markets by surprise. On the flip side, should the CPI rates continue slowing down, implying further easing of inflationary pressures in the US economy, that could weigh on the USD, as it would imply more or less that the market's hunch, or if you prefer, expectation for rate cuts by the Fed would be totally justified once again. On the euro side of the pair, we had a verification of Germany's HICP rate for the month. The slowdown has been verified, which provides some leeway for the ECB to continue cutting rates and maintain a cutting path throughout the coming meetings. It's going to be interesting whether that's going to be reflected in ECB's accompanying statement or ECB President Lagarde's press conference around half an hour later. I would be also noting here that overall the outlook for the Eurozone is not exactly positive. It's not as if the Eurozone is as competitive as the US economy or the Chinese economy. Especially the Germans are having big problems with their auto industries. We're talking about Mercedes, Volkswagen, and BMW. So there's also some unrest on the political spectrum. And it's not only Germany's state elections of Saxony and Thuringia. Um, I would note also the fact that Macron has appointed practically Michel Barnier as the next PM of France, which may not bode well with French voters, which in turn may create some turmoil in French politics. Lots of drama there. But Eurotraders, I think they're focusing on the ECB interest rate decision on Thursday. And at this point, it would be interesting to note that the market seems to be pricing in one rate cut in September, a pause in the November meeting, and another rate cut in the December meeting. Sorry. Should we see the ECB actually cutting rates and delivering a dovish message, preluding possibly another rate cut in the November meeting, that could weigh substantially in the euro, as that would imply that the bank may be more dovish than what the market had priced then. Okay, let's have a look at USD/JPY. USD/JPY edged higher yesterday and is continuing to test the 143.45. At this point, we have to note the failure of the pair to clearly break above it, something which we had expected yesterday. It did not materialize. Hence, we have to switch the role of the support line into resistance line. That's clear. And go downwards to find a new ultimate resistance level. Unlocking the chart, going back. And I'm placing this resistance line once, twice as the new support level at 135 in green. 135.10. It could go lower. See this show here? It's also quite interesting in the sense that you have a test to the downside, which was reversed, and you had tests also to the upside once, twice. So that seems to be pretty valid. And that's 133. At this point, I would also like to lower the second support line in order to include also the shadow here. 137.20. Locking it in. Readjusting the chart. Let's correct the labels. Starting with the S3, which is now being placed at 133. The S2 at 137.20. We're always talking about the USD JPY chart. The S1 at 140.15. The R1 at 143.45. The R2 at 146.85. And the R3 at 149.35. Locking everything in. Now I'm going to be drilling into the 1 hour chart to have more detail in the movement. And I would be highlighting, let me insert a circle here, an ellipse. Note the stabilization. This stabilization tends, in my opinion, to highlight that the direction has changed, and it's characteristic that the direction has changed as the downward trend line, which was guiding it, has been broken. That happened on Friday. So we're switching our bearish outlook in favor of a sideways movement bias back to the 1 hour day chart, and readjusting it. There you go. On the other hand, the RSI indicator bounced on the reading of 30 and seems to be aiming higher. Should it near the reading of 50, that would allow us more decisively for a sideways movement bias. And actually, I'm going to be keeping that sideways movement bias already, possibly below the 143.45 resistance line. Should the pair experience renewed bearish tendencies, that would imply practically a shift of the downward trend line to the right, as the pair may start aiming, if not breaching, the S1 140.15. On the flip side, should the bulls take over, we may see the price action breaching the 143.45 resistance line and start actively aiming for the 146.85 resistance level. We're talking about 300 peeps movement. Let's have a look at GBP USD. Now, GBP USD had practically the release of July's employment data, which was quite interesting in the sense that the unemployment rate ticked down, and most notably the employment change figure practically more than doubled. It tripled. From 97k it went to 265k. There were clear indications that the UK employment market tightened over the month of July. I would be noting here that on the flip side, we had an easing of the average earnings growth rate from 4.6 to 4%, which was not in the positives. On the contrary, it was a negative for the pound, given that it could imply an easing of inflationary pressures in the UK economy as demand is taking a hit. Interestingly enough, let's have a look at the minute of the release, what the market reaction was in cable. This is the minute chart. Let me widen it. And for cable, the market reaction at the release was only about 10 peeps. But you can see how the pair got additional support in the following 1 hour. It's a beautiful upward movement, which definitely was related, in my opinion, with the release of the UK employment data. You can see how there was some slight bullish tendencies, but very, very subtle. And you can see how the pair rose, witnessing a strengthening of the pound 1 hour after the release of the UK employment data. Back to the daily chart. It's questionable whether whether the release will be ending the downward motion of cable. For the time being, we highlight that any bullish tendencies have eased. The RSI indicator is at the reading of 50, implying a rather indecisive market, which could allow for some stabilization. Yet Should bearish tendencies persist, then we may see the pair breaching clearly this time the 1.3075 support line and start aiming for the S2 1.2890. For a bullish outlook, the bar is pretty high. The pair has to breach the R1 1.3260, which would be paving the way practically for the R2 1.3435. It would be interesting to see where the R2 is actually resting on, which peak and what time. And we have to go way back on that. You can see it right here. On 1, 2, 3, 4, 5 candlesticks here, this team of candlesticks around the beginning of March 2 years ago. We're talking about March 2022. It's way, way back. So, technically speaking, in my opinion, it will be hard for the pair to breach the R1 and enter levels which have been uncharted for the past 2 years. On the other hand, I'm maintaining the idea that the bearish tendencies are still present as the price action is forming lower peaks, lower truths. Yet, for a bearish outlook to emerge, the pair's price action cable's price action has to breach the S1 1.3075. Without it, there's no bearish outlook in sight. Let's have a look at USD CAD. The pair seems to be stabilizing over the past 3 days just below the R1 1.3590. It seems to be experiencing some difficulty to actually breach above the level and thus open the gates for the 1.3720. So for the time being, we tend to maintain a bias for a sideways motion to prevail. That's also being more or less implied by the RSI indicator, which is on the rise and has neared the reading of 50, implying that the bearish sentiment has faded away and the market is in a limbo on what the direction of the next leg of the pair will be. Once again, for a bullish outlook, we would require the pair to breach the R1 1.3590 and start aiming for the R2 1.3720. I would be also noting here on a fundamental level the path of oil prices, as a possible rise of oil prices could provide some support for the Canadian dollar and vice versa, given Canada's status as a major oil-producing country. On the other hand, should the bears take over again, then I would expect nothing less for the pair than to breach the S1, breach the S1 1.3475, and start aiming for the S2 1.3340. Let's have a look at the Aussie. AUD USD falling. There was an intensification of the bearish movement on Friday, that was clear. However, the bearish tendencies seem to be maintained also yesterday and during today's Asian and early European sessions. I would be noting here the release of China's August trade data. We had a wide acceleration of the export growth rate. If I'm correct, reached 8.7% year on year. And on its own, it's a positive. But there is a catch which tends to worry me somewhat, and that would be the import growth rate. It slowed down and reached, if I'm correct, 0.5% year on year, which was a bit of a shock. And if we discuss that exports are rising, but the imports remain unchanged practically, that could imply more or less that we have a weakening of the internal demand side of the Chinese economy. By the way, the trade balance widened substantially, more than expected. Actually, the trade surplus was expected to narrow. It didn't widen and breached above 90 billion US dollars. So that was another positive for the Chinese currency. However, I would like to have a look at how Aussie traders reacted to the news. We can see how the pair was on the rise in the late Asian session today. You can see all this upward movement. This is the 1 minute chart, peaking practically at 0.6670. No, it went even higher, 72, and then correcting abruptly lower. And that was clearly in the European session now. Back to the daily chart. So we tend to maintain a bearish outlook for AUD USD, setting the next possible target for the bears at the S1 0.6575. Some hesitation is also present given that, okay, the RSI indicator broke below the reading of 50, but at its own slow pace. But the indicator is forming lower, shows lower peaks, which may imply a continuance of the weakening of the market sentiment for AUD USD, or if you prefer, a build-up of a more bearish sentiment for AUD USD by market participants. Once again, should that be the case, we may see the price action aiming, if not breaching, the S1 0.6575. On the flip side, for a bullish outlook, I would require the pair to rise, breach the R1 0.6710. That's more clear than anything. I would require it also to breach the downward trend line, which has been guiding the pair over the past 10 days, signaling exactly the interruption of the upward movement. But in my opinion, for a bullish outlook to come into effect, the pair has to breach also the R2 0.6795. I know it's a little bit too much to ask, but I'm a little bit more conservative on that. I would like to feel more certain about the bullish outlook, and breaching the R2, I think, would be a better signal. Let's have a look at US stock markets. Let's allow for US stock markets to be the last. I'm going to be starting with WTI. Now there's intense downward motion. And definitely the downward motion has intensified, like here. The RSI indicator is nearing the reading of 30, also implying a rather strong bearish sentiment on behalf of the market for the commodity. And should the bears continue leading the race for WTI, I wouldn't be surprised to see it dropping as low as the 0.6410. For the time being, we note that the commodity's price is at levels which have been last time seen right here. And this shows here 1, 2, 3 tend to form a support line. However, that's pretty much, I wouldn't say outdated, but predated. We're talking about June 2023 last year. So the commodities price is at low levels which have not been seen for over 13, 14 months. also the fact that the price action is flirting with the lower Bollinger Band may slow down the bears somewhat, if not even cause a correction higher. Once again, and as long as the downward trend line remains intact, we tend to maintain a bearish outlook for WTI's price and expect it to start aiming, or if not breaching, the 0.6410. Should the bulls take over, I would see the price action of WTI reversing direction, breaching the pre-mentioned downward trend line, exactly in signal that the downward motion has been interrupted, breaching the 67.90, and in my opinion, I would like to see it above the R271.40 before actually adopting a bullish outlook for the commodities price. Now, the fundamentals, I would be highlighting the release of AP's weekly crude oil inventories figure. It's due out in the late American session today. And should we see a surplus, or if you prefer, an increase of US oil inventories, that could weigh on oil prices further. In any case, any release from AP may also require some confirmation from EIA tomorrow. Let's have a look at gold. Gold's price in a very tight range-bound movement between the R1 2530 and the S1 2470. Volatility is very low. It's characteristic how the Bollinger Bands have narrowed, and that could allow the sideways motion to be maintained. There were some traders which have discussed the possibility of an upward outlook, a bullish outlook, given that the precious metals price had 1, 2, 3, 4 higher peaks. I understand the higher peaks, but at the same time, I'm highlighting here that the commodities price has hit a ceiling at the R1 2530, and for the bullish outlook to reemerge, I would require a clear break of the R1 and the precious metals price, the bullion's price, to aim, if not reach, the R2 2600. Now, at this point, it would be interesting to note that the R1 practically is signaling an all-time high for the precious metal, which on the one hand may be bringing some cold feet for gold bulls to advance further. On the flip side, though, it's interesting how gold's price action respected the level, but at the same time remains close by. It's as if it's waiting for the opportunity to breach it. It's not going back, it remains there. And that may imply the possibility for some future bullish tendencies for the precious metals price. For a bearish outlook, I would require gold's price to breach the S1 2470, but also breach the upward trend line, which is right here. And that would be signaling the end of the upward movement, with the next possible target for the bulls after the S1 being the S2 2420. Let's have a look at Dow Jones. Okay, Dow Jones has an interesting movement because yesterday it was able to recover all the losses of Friday. You can see the two candlesticks standing side by side. This was the red candlestick was the bearish movement of Friday, and the green candlestick was the bullish movement of Monday. For the time being, it seems as if there is a slight correction lower. However, that could be a prelude for an upward movement. It would be interesting to see how the American stock markets will be opening today. The RSI indicator for the time being is stuck at the reading of 50, implying a rather indecisive market. Let's have a look at the hourly chart in order to have more detail here. And we can see how your stock market started rising intensified the rise right here. And that was the opening of the American session. If we drill into the half-hour chart, it will become even more obvious. Starting 1, 2, 3, 4, correction, 1, 2, 3, 4, correction lower, and stabilization. So Dow Jones, for the time being, seems to be in a wait-and-see position. Once again, the American Open should provide us with more clues about its direction. Let's have a look at NASDAQ. If we can find it right here. Before that, S&P 500 will be also quite interesting. It's interesting how the Ichimoku cloud now is above the level. And we have a price action which is just below the S1 5490. Hence, the S1 has to be turned into a resistance line. And let's go lower. This true here would be quite telling. In green, 5120. Widening the chart. Let's reposition and correct the labels. By the way, I was watching, before I came here for the presentation, the event for Apple. I think it was disappointing. It was disappointing in the sense that there were no major features, new features, no major innovation in the of the new iPhone. And in my opinion, that could weigh somewhat on Apple's share price. At the same time, I would be noting that the company lost the case for the reduced tax in Ireland, and that could weigh on the share price as well. In my opinion, that's only the tip of the iceberg. The EU is going to be cracking down on such large companies. It's going to be something which overall could weigh on the tech sector as such. Now, back to the S&P 500. I would expect the price action to stabilize somewhat. Yet we note that we had considerable downward movement. That was until Friday, a correction higher, and slight stabilization during today's Asian and early European session. The movement is almost identical to the Dow Jones, and in my opinion tends to highlight the possibility of a sideways motion just below the 5490 resistance line. That should sum it up for the day. From all of us here at IronFX, best wishes for solid trading.
Okay, let's go ahead and get started. So, um, for those of you guys who've just joined, today we are talking about the advanced harmonic strategy. As per usual, before we get started, a disclaimer and risk warning. Our products are traded on margin and carry a high level of risk, and it is possible to lose all your capital. These products may not be suitable for everyone, so you should ensure that you understand the risk involved. Disclaimer, the information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. This material is just the personal opinion of the author, and the client's investment objectives and risk tolerance have not been considered. IronFX is not responsible for any loss arising from any information contained herein. Redistribution of the material is strictly prohibited. So I'm Melanie and I'll be your speaker for today. I'm an investment analyst from Rocket, who are finalists for Best FX and Equity Research in the years 2019 to 2021. So here's our agenda for today. We're going to do a brief recap on Fibonacci in case any of you guys weren't around for those webinars. And then we'll look at market structure, followed by an intro to harmonics, and then we'll look at the different types of patterns. So feel free to let me know in the chat if you guys have any questions throughout the webinar. And yeah, let's go ahead and get started. So firstly, let's start off with the different Fibonacci retracement levels. So these are the Fib numbers that we normally use. So you can take a screenshot here if you want. But now that we know how to draw the Fibonacci retracement trend line, which you can see in the GIF here, basically drawing from the top to the bottom, ensuring that you follow the shape of the market structure pretty closely. Okay, so then we can look at the different types of levels. So we have the levels that are ranging from minus 61, all the way to more than 100%. Why do I feel like my video is kind of lagging? Okay, yeah. Where was I? Yes, so these are the different levels that we use, and they each have a different technique for the range. So for the negative levels, so minus 61.8 as well as the minus 27.2, we look at using Fibonacci expansions. So an expansion, I'll show you guys how we can use it in a bit. Next, we have the mid-range Fibonacci retracement levels, and those are from the 23.6 to 78.6. And then lastly, we have the levels that are greater than 100%, which would be our extension levels, and those are the 127 and the 161.8. Okay, so you can see the main three levels that I talked about in our previous slide are the retracements, expansions, and extensions. And you can see exactly how they are used in our GIFs here. Don't worry too much about this projections GIF, because we're not going to be focusing on that for now. So for retracements, it's exactly the same. You're just following from the top to the bottom. For expansions, which are the levels that are less than 100%, less than 0%, so the negative levels, you're mainly looking at finding this lightning bolt kind of shape or like a flash symbol. And then you're taking the starting point and ending point, and you are kind of projecting where prices are headed towards once price has fully surpassed that level here. Okay, so it has to surpass or retrace at least 50% of your initial trend line before you can use this expansions technique. Okay, and then we're projecting where prices will head towards the minus 27 or the minus 61. Okay. As for extensions, we are looking for reactions off of the levels that are greater than 100%, so 127 and 161. And for extensions, we are looking for this Nike tick kind of shape. So you can see our starting point, ending point here for our trend line. Once price has fully surpassed that 100% starting point, then you can go in and use this technique. Okay, so we're basically watching for reactions off of the 127 and 161 for this technique here. Why do I feel like my video is frozen again? Can you guys hear me? Okay, I think the audio is fine. It's just the video. Um, so I'll just switch the video off for now. Oh, is the video okay as well? Okay, now it's okay. Okay, let's just move on. So if it freezes again, I'll just switch the camera off. Okay, video is stopping. Yeah, I'll just switch it off then. The next time that it freezes. So anyway, these are the different Fibonacci retracement levels if we're looking at it all at one glance. So you have the positive Fibonacci retracement levels that are greater than 100%. Over here, those are your extensions. Your mid-range would be between the 0 and 100, and your negative Fibonacci retracements, which are also your expansions, those would just be the minus 27.2 and minus 61.8. So the reason why we are going through Fibonacci first is because harmonics plays a lot into the theory um, behind Fibonacci levels. Okay, so we'll just do a brief recap on it in case there are some of you guys who haven't been with us for that long. We do have a four-part series on Fibonacci if you guys were interested on that. Um, yeah, so we go through in depth in each webinar the different types of Fibonacci's. But for this webinar, I'll just do a really quick run through of each of the techniques. Okay, so let's move on. We're now going to look at a couple of examples. So here you can see I've drawn a retracement level from this 0 to 100. My prices have rebounded off the 61.8 level. Here you can see prices are rebounding off this overlap level. So what an overlap level is basically when there are swing highs and swing lows that respect that area. We call it an overlap because the bulls and bears of your price are respecting that area. Okay, so here we can see our 38.2 prices reacting off of it. And that's also in line with that overlap level. So when you combine your horizontal levels, like your pullback, your overlap levels, with your Fibonacci levels, then it really strengthens your analysis and the chances that prices are going to rebound off those levels. Okay, so for harmonics, normally it plays off of the 61.8, which is also called your golden ratio for harmonics strategies. So the main levels that harmonics uses are the 61, 78, and also the 127 and 161.8 that we went through earlier. So the 38, okay, just give me a second. Okay, sorry about that. Um, yeah, so For if you're just using Fibonacci without the harmonics, we look at all of the levels. But I just wanted to highlight, since we are talking about harmonics, 61, 78, and the levels that are greater than 100, which we'll touch on in a couple of slides. So in this slide, we are focusing on the 61.8 level. First retracement we have is this bigger one here. And you can see the 61.8 lining up with the swing high here. The second Fibonacci retracement we have is from this swing low to the swing high. Prices bouncing off of this swing low support level are also in line with a 61.8 retracement. Okay, so this shows you 61 is a pretty common level that's used to determine potential reversal points within harmonic patterns. Okay, here we are briefly touching on Fibonacci expansions. So for expansions, I talked about the flash kind of shape, or like a lightning bolt symbol. So you can see the yellow arrows kind of form that shape. So your expansion level basically traces out the start or the head of your shape. Okay, so this works especially well because you have the mid-range Fibonacci levels. Here you can see a 61.8. And you're also using the negative level. So the minus 27.2 is where we are projecting price to come down and bounce off of. So your 61.8 is your typical retracement level that we've seen in the previous examples. And your minus 27.2 is basically where we are expecting prices to reverse off of. So you can see that's exactly what happened here. Price bounces off really nicely from the minus 27.2 expansion level. Okay, a pro tip is that price usually comes back to the ending point. Ending point is basically the first swing low of your shape. Okay. Okay, so now let's look at extension levels, which are your Nike tick levels. The yellow arrows draw out really nicely the shape. You're basically taking the head of your tick and projecting prices where prices will reverse off of. So this Fibonacci extension is also commonly used in harmonics as well. So namely the 127 and the 161.8, like we see here, prices are reversing off of it. And yeah, so you see that huge reversal off of this level here. Okay. Okay, so here's a GIF that shows you how to identify the shape and also how to draw your trend line and what you can expect to see from this 127 and 161 levels. Okay, so for Fibonacci projection, I'm not going to dwell too much on this. I'm just going to briefly mention it a bit. But basically for your Fibonacci projection, we are using that same flash shape that we saw for your expansion levels, so the levels that are less than 100%. For extensions, projections, we are using the Fibonacci extension tool. So it's a bit confusing, but it's a completely different tool compared to the tool that we've been talking about for the past 3 strategies. So for this method, we're using the Fibonacci extension tool on TradingView, and that basically uses 3 points. Okay, so you can see in the GIF, we have a starting point, middle point, and ending point. And the levels that we're looking at are 61, 78, and 100. 161 if you're looking at using an Elliott wave. So ultimately, unlike the other 3 methods that we went through, this uses 3 points. So 1, 2, and 3, and you are following exactly that lightning bolt kind of shape and projecting where prices are going to reverse off of. Okay, if we look at another example of this, you can see really clearly the starting, middle, and ending points follow the swing highs and lows of price. And price has bounced off of that 100% very nicely over here. So here's an example with a very obvious zigzag or lightning bolt shape. Here you want to take note of the Fibonacci trend line that follows the market structure really closely to project the price to reach your 78.6% Fibonacci projection level. Okay, so let's see how this plays out. So you can see price has reversed off the 78.6% Fibonacci projection according to our previous analysis. Last example, take note of that zigzag shape again, or flash shape. This time it's kind of inverted, so instead of being upright like this, it's upside down. Notice that there is a very clear movement in price structure, which our Fibonacci projection trend line follows. The starting, middle, and ending. And then your last part, or the tail end of your lightning bolt shape, follows your projection. So you're projecting where prices will bounce off of. So here you can see we're projecting prices to bounce off the 100%, and that's exactly what happened here. Okay, so for invalid Fibonacci retracements, one of the most common scenarios of this is when price makes a lower low. So that's assuming if you are drawing a Fibonacci retracement from the top to the bottom. So if there are bars on the right that break your ending point, it then becomes invalid. So there are Fibonacci retracements that are in negative that we saw earlier, but basically they go beyond your endpoint and they are still valid. So for example, here we have prices breaking below your ending point. So this then becomes an invalid retracement. So you always want to remember to pick the lowest point with nothing on the right of that ending point. Okay, now let's talk about market structure. So this is pretty important regardless of whatever strategy you are using, but particularly for harmonics because you're basically using price action. So these swing highs and lows are too insignificant, so they're bad points to use for your Fibonacci points, but they're also bad points to use for your support and resistance levels as well. Okay, so when you're choosing a chart, you can flip between the different time frames to choose a chart that gives you a really clear market structure with significant swing highs and swing lows. So you can see that the Fibonacci trend line cuts through the price structure. So this is something you want to avoid, especially when you are drawing your harmonics shapes. You want to make sure you follow price structure very closely. Okay, we saw this earlier. Okay, so let's get into our brief intro to harmonics. So harmonic patterns are pretty popular trading strategy since it involves technical analysis and it identifies potential price reversal points in financial markets. So these patterns are based on Fibonacci retracement and extension levels, which is why we went through them before going through some of these patterns. And these are basically mathematical ratios that traders believe are significant in determining potential support and resistance levels. So harmonic patterns foundation was laid by H.M. Gartley in 1932 and later developed further by many authors like Scott Carney in his book of harmonic trading. So harmonic patterns basically reflect geometric price structures. So for example, retracements, projections, and swings. These adhere to Fibonacci ratio relationships. In other words, retracement, the projection price swings that form these patterns and are interlinked together based on specified Fibonacci ratios. So the ratios that we normally use for harmonic patterns are those I mentioned earlier, 61, 78, and the levels that are more than 100, so 127 and 161. So these harmonic structures exhibit unique price structures or movements and key turning or trend reversal points. This factor is very helpful in trading as it provides highly trustful price entries and key levels for targets or stops. Unlike other trading methods, harmonic trading attempts to predict future movements, and this is what differentiates it from other indicators or oscillators, which tend to be lagging, and in terms of how they work as well. Okay, let's briefly talk about some basic pattern identification. So some of these patterns can be quite complex and a bit technical to understand, but once you understand the pattern structure, they can be spotted quite easily. So these patterns are either forming or completed M or W shapes. Or they could be combinations of M or W as well. So all primary harmonic patterns are 5-point patterns with points X, A, B, C, and D. And price swings between these points are interrelated and have harmonic ratios based on Fibonacci. Okay, so Fibonacci ratios are really helpful in trying to understand and defining precise turning points in these patterns. Okay, so starting off with the W bottom, you can see where exactly we're expecting price to break out of, where you should place your targets. For an M as well, it's just the opposite. So there are many variations of the W or the M patterns. And yeah, this is what we're talking about, the A, B, C, D, E shapes. Or it could be labeled as X, A, B, C, D as well. The main thing is that there are 5 points that are labeled on your patterns. Okay, so here's a 5-point pattern example. So all 5-point harmonic patterns have similar principles and structures, and they differ only by the ratios that are used to identify them and locate their keynotes X, A, B, C, and D. So 5-point harmonic patterns have a critical origin X followed by an impulse wave XA. That's followed by a corrective wave to form the I of the pattern at B, completing the AB leg. So basically this purple level there. And then it's followed by a trend wave, BC, and finally completed by a corrective leg, CD, that ends around the potential reversal zone. So if you look at this diagram, the levels, these like 0.38 to 0.618, these are your Fibonacci levels that we're using. So if I were to place a Fibonacci trend line here, one here and the ending point here, you can see that price has retraced 61.8% of your original line. So that's basically just what the levels mean. Okay. So here you can see projection at 161.8, retracement at 88.6, projection 261.8. So a possible pattern formation is identified after the first three legs, XA, AB, and BC are completed. So you're projecting your reversal to happen from somewhere here. Okay. So your entry level should start about past this area here. So potential trade setup is recognized as the last leg CD starts to develop. Fibonacci ratio extensions, retracements, and projections are then used to determine your potential reversal zone or your PRZ, which you can see here. This is basically your if you've been with us, the Fibonacci confluence area, this could be one of your area as well. Because you're basically projecting prices to reverse off of that area. So hit down, be attracted to the area, and then bounce off. So it's kind of that same concept. So all harmonic patterns have a clearly predefined PRZ. The initiation of new trades should take place in this zone and only after price reversal pattern action. Okay, so let's start with the first pattern, which is the Gartley pattern. So it was first outlined by H.M. Gartley, and the Gartley pattern is probably the best known harmonic pattern. Structure and appearance wise, the Gartley pattern typically forms in a trending market, and it has an M shape in a downtrend or a W shape in an uptrend. Okay, so remember, because these are kind of reversal patterns. So that's why we're calling this a bullish Gartley, because it should be in a downtrend, and then we're looking for a reversal into an uptrend. Bearish because it's an uptrend, and we're looking at a reversal into a downtrend. So how it works, or the rules for a harmonic pattern, the AB leg should retrace about 61.8% of leg XA. BC should retrace 38.2% to 88.6% of XA, and CD is at least a 78.6% retracement of leg XA. Okay, so long positions should be considered after a clear bullish reversal with a stop loss that's placed below here. So you can see the PRZ happens around point D. So we're going in for a buy here, and you place your stop loss below your buy level. So target 1 for this pattern is at your 38.2% retracement of your AD. So if you draw a Fibonacci retracement here, as long as it's 38.2% above 38.2, you can place your target profit there. While target 2 extends towards the 61.8% of AD. So if price breaks out of that 30.2% retracement, then you can go in continuously for a buy towards your 61.8. So the bearish Gartley, of course, is just the opposite of that. If you're using a bearish Gartley, your short positions should be considered after that clear bearish reversal. So off of this D with a stop loss placed above the D level. Okay, again, target for this pattern is 38.2% retracement AD, while target 2, 61.8% retracement of AD as well. Okay, so the concept behind Gartley pattern is based on the idea that after a significant price move, so this huge shoot upwards, the market will retrace AB followed by another move in the original direction before completing the pattern with a final leg, which is your CD. And this ends at a Fibonacci retracement of your initial A move. Okay, so once you understand it, it's pretty straightforward. Okay, now let's look at the next pattern, which is your bat pattern. So the bat pattern is typically considered to be the most accurate pattern In terms of structure and appearance, it's pretty similar to your Gartley, but has a different Fibonacci ratio. Also has an M shape in a downtrend or a W shape in an uptrend. Okay, so the main rules of the bet are AB can retrace between 38.2 to 50% of XA. BC can retrace between 38.2 to 88.6 of AB. And CD can retrace up to 88.6% of XA. CD leg can also be an extension of between 161.8 to 261.8 of AB leg. Okay, so your completion D typically will lie about 88.6% retracement of your XA leg, like we see here. Okay, so for long positions, you can consider them if we're looking at bullish bet, long positions would be after that D level. So you place your stop loss here. Your potential reversal zone will be this purple highlighted point, and prices are headed upwards, so you can place your take profit. Again, 38.2 retracement of this level, AD, or 61.8 as well. Stop loss will just be placed below here. Similarly for bearish bet, prices heading downwards, your stop loss will be up here, somewhere here, and you're heading towards 38.2 or 61.8 retracement of your initial leg, which is your XA. Okay, so the difference between bet pattern and Gartley is that the bet pattern emphasizes a deeper retracement in this AB and also a shorter extension in the CD leg compared to Gartley. So it's also considered to be more reliable than Gartley due to this deeper B retracement, which also allows for better risk to reward ratio. Okay, any questions so far? Okay, if not, let's move on to the next pattern, which is the cipher pattern. So for cipher, again, it's formed by 4 price swings that's labeled as X, A, B, C, and D. This is more complex compared to the other harmonic patterns. And yeah, it also uses different Fibonacci ratios. So the Fibonacci relationship here, XA leg, which is the initial price movement, can be either direction. So here it's up, bearish would be downwards. So your AB leg after that should be between 38.2 to 61.8 of the original XA. Your BC leg is a sharp extension of AB, typically extending to 127.2 or 141.4 of the AB leg. So here you can see we are employing that Fibonacci extension technique that we used earlier. BC leg is, we talked about that already. Your CD leg retraces from your BC leg, ending at a level between 78.6 and 100 of your XC leg. So for this level, you would connect your X to your C level in order to determine whether your D is part of the cipher pattern. Okay, so this is pretty distinctive from the final leg of other harmonic patterns, such as your butterfly or your Gartley. Yes, an entry is after the pattern. Endpoints of the legs are wicks or body of candles. We normally will include the wicks as well because we are using Fibonacci levels. Yeah, so even if we're not looking at harmonics, just Fibonacci, we take into account the wick as well. But yes, entry is after the pattern. So once this pattern is completed and we start to see that reversal, then we will go in for the buy. For bullish, for bearish, here you can see, that's why we call it bearish, because once price is moved up, once it reverses, we're going for a sell here. Okay, so the concept behind this pattern is based on the idea that after a specific series of price movements, and you can see it's very specific in terms of the retracement levels, um, the market is likely to reverse direction. So it differs from other harmonic patterns in that the BC leg, so this one here, extends beyond the starting point of your XA leg. So it creates a deep retracement for your CD. Okay, so again, this pattern is considered one of the most accurate harmonic patterns um, with a high probability of predicting your reversals. Okay, so again, target levels you can stick to typically 38.2 to 61.8 of your CD leg here. So you place your target somewhere 61 or 38. Stop loss will be placed slightly beyond this X to protect against a false breakout. Okay, any questions? Okay, here's an example of your cipher pattern on an actual chart. So you can see, yeah. So I think if you look at it at one glance, you can't really see what's going on. So you do have to go in and use your Fibonacci retracement tool to label all of the levels, the 78.1 that we mentioned, the 127, yeah. But yes, so you can see once price reverses off of that D level, then we'll go in for a buy. These patterns can work on any chart. You can see in this example, we're looking at Euro Yen on the 1 day time frame. So I'm sure you could find it on gold as well. Although now on gold, prices are kind of moving in an uptrend, whereas these harmonic patterns tend to work better in trending markets. So, but still, you might be able to find it on gold as well. So yeah, it works on any kind of chart. Okay, let's move on. So next, we're going to look at the butterfly pattern. So butterfly pattern also uses the M or W shape, but it's different from Gartley and Bed in that it extends beyond the starting point of your pattern, which is your point X. So the Fibonacci relationship, again, we're looking at AB retracing 78.6% of your initial price movement, so XA. And then for your, I talked about AB, yeah. So next is BC, and you would be looking at a 78.6% retracement, 30.2 to 88.6 retracement on your XA. and your CD would just be a 1.61. Um, or actually, these are levels greater than 100. So it'd be 161.8 to your 261.8 level. So again, here you are seeing that same Fibonacci extension level. Okay, so yeah, that's why we went through your Nike tick shape, because you can see very clearly how it would work on some patterns as well. Okay, and lastly, of course, your CD is a 127 to 161.8 retracement of your XA. Okay, so concept behind this is that it basically indicates a potential market reversal beyond this starting point. So that's the difference between godly and bad. It's also a more aggressive pattern, so it predicts a stronger reversal. So it's based on the idea that the market often will overextend beyond the initial impulse move, which is your XA, before it starts to reverse. Okay, we have a question. Are the patterns best seen on daily charts? It kind of depends on your trading style. Um, we normally will use this on either daily or for 1 hour or 4 hour time frames. So we normally won't go anything below 15 minute. I think 30-minute works as well. But anything below 15 minute tends to get a little bit harder to analyze because charts are noisier. Yeah. So normally 30-minute, 1 hour, 4 hours, or daily works as well. Okay, but generally your harmonic patterns increase in reliability with higher time frames because they are less influenced by, your short-term fluctuations and market noise. So that's why we normally use 4 hours or daily. Okay. Lastly, or not lastly, but we are going to look at the crab pattern. So crab pattern was actually released in 2001, and this is a pretty extreme pattern as well because the corrective wave, your AB, should end between 38.2 and 61.8. Okay, so for the Fibonacci levels, you're basically looking at XA as the initial price movement again. AB is the retracement of 38.2, 61.8, as I mentioned. BC is 38.2 to 88.6 of your AB. CD is just the defining feature of your crab pattern, um, which is an extreme extension of the XA leg. You can see it's 161.8. It can actually go even higher. So if you look at your BC extension, here if you're using the Nike tick method that we used earlier, you'll be looking at somewhere between 224 to 361. So this is the defining feature of your crab pattern. Okay, so this pattern was discovered by Scott Carney, and it's considered one of the most accurate harmonic patterns as well, simply because of this deep extension of the final leg. Okay, so yeah, this is one of I think it's the largest extension, especially for the last leg here. Okay, Next, let's look at the shark pattern. So this pattern is relatively new, also introduced by Scott Carney. Um, this pattern is unique because it doesn't follow that traditional XAB CD structure that we've seen in the other harmonic patterns. Instead, it uses a 5-point structure that's labeled OXABC. So it's known for its sharp price patterns or price movements and the ability to identify potential reversal zones before the final point of traditional patterns. So structure and appearance-wise, it's characterized by this steep OX initial move, followed by a sharp retracement of your XA, deep extension, again your AB, and another retracement BC, which is and is considered a continuation or a reversal pattern depending on where it forms in the trend. So in this example, we are using it as a reversal. That's why you can see price after the completion of the shape. We are projecting it to reverse. But if you found it somewhere between the BC line, of course, you'd be expecting a continuation. Okay, so the strength of shark pattern is that it is able to identify potential reversals earlier than the other patterns, such as your crab and your bat, because you're looking at the at you're looking at this price pattern before its completion. So you don't have to wait for your C level to form before going in for your trade. Reason being, your BC level is so long. So if it doesn't fall within this 113, you can just assume that prices are going to continue. Once it hits or it falls anywhere between 113 and 161.8, projection of your AB, then you can go in for a buy or sell if you're looking at the bearish shark pattern. Okay, so the target profits, where you should place your target profit and stop loss. For all of these patterns, lies about 38.2 to your 61.8 retracement of your this final line here. And then your stop loss would just be outside of that initial line. Okay, now let's look at the advantages and disadvantages of harmonic patterns. So harmonic patterns provide future price projections and stop levels in advance and are considered leading indicators. They're frequent, repeatable, reliable, and produce high probable setups. And the trading rules are relatively standard since they're using Fibonacci ratios, and they work on all time frames and on all market instruments. Other momentums, other momentum indicators like your CCI, RSI, MACD, DMARC, and so on can be used along with them as well. Some disadvantages: harmonic patterns are complex and highly technical to understand. Correct identification and automation or coding of harmonic patterns is difficult. Conflicting Fibonacci retracement and or projections make it difficult to identify the reversal or projection zones, and complexity arises when we get opposing patterns from different time frames. Yeah, so the risk reward factors from some of the patterns are also pretty low. And yeah, that's all I have for you guys for today. Let me know if you guys have any other questions. But if not, yeah, thank you guys so much for joining me. I hope you guys found this session helpful and have a great rest of your week. And if you guys like me, feel free to connect with me on LinkedIn. It's just my name, Melanie Chong. And yeah, I'll see you guys again next week. Thanks, everyone. Bye.